In this video, we have a jam-packed agenda plan for you. First, we'll dive into the Bank of Canada rate cuts, when they'll happen, by how much, and what impact you might expect. Next, we'll discover the latest expectations for housing inventory, then explore the correlation between transaction volume and housing prices, then get insights into rent projections, and lastly, find out about current price trends for both freeholds and condos. And as a special bonus, stay tuned for a prediction on why the best real estate opportunities might be closer than you think.
Everyone wants the best deal, but when it's right in front of your face, slapping you around, you often just completely miss it. Here are our 2024 market predictions if you're a buyer, investor, or move-up buyer in the Toronto real estate market looking to make an investment decision this year. Hi, I'm Amir, the lesser half of the AmirAndAleks realty team. We've been doing this for over 15 years, and we hope you enjoy the content we're producing, and it gives you some insights as to what you should know before you make any sort of decision in the market. Number one, the Bank of Canada is not going to cut rates, at least not until June or July of this year. This is a very important point to note. Most of the narrative that you're going to find, particularly on social media, is going to hint at the fact that the bank's going to be lowering rates and therefore this is the time to buy. That is not entirely true. That is what causes FOMO. And if you believe that too much, and everyone else does too, you're just going to prop the market up. The Bank of Canada is not concerned over your or my welfare, or for that matter, the real estate market. Their primary initiative is so that we do not end up in a massive inflationary environment. We want to get inflation back down to 2%, and so that is their mandate. The real estate market plays a factor in that, but it's not the driving factor. They're not going to lower rates because you and I have issues purchasing a home. Right now, it's unlikely the bank is going to cut rates until June. That would be their first cut, maybe July, and then probably by the end of the year, another cut. If we have 3 cuts, we'll probably see a policy rate or the bank rate at 4.25. Today it sits at 5. The max we predict they're going to go down to is about 4.25 across 3 cuts, again, between June, July, and maybe November, December. Prediction number 2, the inventory will be much higher than it was last year. Last year, we saw a massive slump. This was the first year where we were in high interest rate environment, and this was off the tail of 2022 when the bank started raising rates. In 2023, we had an entire year of rates kind of going up, and this resulted in affordability going down. Sellers were less inclined to put their properties on the market. They were looking for properties they weren't sure they're gonna get, and therefore we saw a massive decline in inventory. So naturally this year, a lot of the properties that sat and didn't sell are going to come back on the market. This, coupled with properties that naturally will list this year, will result in an uptick. How much? Probably 20-30%. Last year was a 65,000 transaction. This year it'll be probably closer to 85, 90,000 transactions. Let's say 33% uptick in actual transactional volume. Not prices, but the volume. The number of transactions that actually occur in this year will go up by about 30%. Prediction number 3. Just because we have more transaction volume, that doesn't necessarily equate to higher prices. And we need to segment this into 2 parts, condos and houses. So first, let's start with houses. Houses remain relatively unaffordable when you compare them to last year. Not in general, I'm just saying you can't see these massive appreciations we've become accustomed to over the last decade simply because the affordability hasn't changed. Nothing's changed. The policy rate sits at 5%. We're unlikely to see any rate cuts until June or July. So your affordability as a consumer hasn't changed, and therefore the only factor or variable that's driving people to purchase could be FOMO, news out there, headlines, and that's not necessarily actually objective reasoning. Therefore, prices for homes are not necessarily going to go up because the banks are not going to appraise them for anymore. Nothing's changed. You're still going to see prices kind of hover around the same. Slight upticks maybe in certain communities based on schools, someone wanting to move, etc., but not these massive price gains that we've seen time and time again over the last 10 years. Let's talk about condos. So the way it's gonna work is like this for condos, okay? Look, condos were on a decline last year, and that decline continues into this year. The simple reason is that the rents are not keeping up with what it costs to carry these properties. People are running a massive deficit, meaning they're losing money every single month, every single year. For as long as they hold it, they need to now make up that loss so that they break even, so that they're whole. So at one point or another, it just doesn't make any sense. If you're losing $1,000 a month on a particular investment, that's another $12,000 that you have to actually gain in appreciation just to break even. So at one point or another, these investors are going to be offloading. This is no longer making any sense. I've made enough money. I have a giant gaping hole in my abdomen. I need to stitch it up. I can't worry about winning the war right now. I just need to live to fight another battle. That is the mentality for people who own condos that invested, let's say, 0 to 5 years ago. As this offloading happens, it's going to be a race down, not a race up. So sellers are going to have to start fighting with each other to actually see who gets to sell their property faster to an available and willing buyer. That means if you're someone holding and running a deficit, stop playing with fire. If you can get out and be whole, or you've made some money, don't get greedy. That's how you're going to get caught in the trap. Get rid of the condo, liquidate, get your cash available, and reinvest. Live to fight another day. Don't worry about winning the war. Your abdomen's open, your organs, we can see them. Just stitch it up. And then you can win the next war. That's the idea. How far are they gonna go down? At least another 5%. Let's take, for example, Yonge and Eglinton. Huge flood of inventory, both in rentals and sales. Let's say 2 bedrooms right now. You're not gonna win this. There's too much inventory. Buyers have too much selection. And therefore, it's in your best interest as a seller, offload, reinvest, get your cash ready, because that's how you're going to be in the best position possible to actually invest into something else that will appreciate. Prediction number 4, rents are not going to go up by a significant amount. Remember, you're governed by the Landlord and Tenant Board of Ontario. You can't be raising arbitrarily, and therefore it's unlikely you're going to be able to cover the massive deficits that we're seeing based on the high rates. So rents are probably going to stay kind of level, make seasonal adjustments as people are looking for more rentals, let's say in the summer and spring markets, or maybe in the fall just before school. But generally speaking, not huge jumps in rents either. And prediction number 5, you're going to see no substantial movement in prices when it comes to housing, houses in particular. And the simple reason is affordability. At the end of the day, even in the best case scenario, if the Bank of Canada were to cut rates 3 times, I said at the beginning of this, you're probably going to end up around 4.25. This means the banks are going to give you rates around 5, 6, 7%. This is almost triple what someone would have signed on for, let's say 3, 4, 5 years ago. Therefore, they're carrying at a much higher rate than they were before. It's not going to be pleasant, and therefore we're not going to see massive fluctuations in price. Those who move are generally moving because they have a reason. Move up purchasers needing more space. First-time buyers that want to get into the market and capitalize on the fact that the investors who are offloading may be doing so at a discounted rate. And this is a bonus prediction. Prediction number 6. Everyone wants the best deal, but when it's right in front of your face, slapping you around, you often just completely miss it. And the reason is most of us are programmed to follow. This is not because you suck or I suck, it's just natural. We follow because that's probably the path of least resistance. If others are doing it, then I should probably be doing it too. If others are not doing it, I probably shouldn't either. But that's precisely what separates those who are super wealthy versus those who just can't seem to kind of bridge that gap. The wealthy tend to get wealthier in down markets. That's just the way it works. And the reason often is because they have the liquidity or the cash to support down markets. So they might not sell when everyone else is selling, etc., etc. But if you can figure out a way to get into down markets, particularly in this market, the condo market, this can be a huge advantage to you because ultimately you may carry it for a little bit more for some time, but you may be getting it at a massive discount. So you're literally buying with some equity that's built in. Something that was valued at $900,000 sells at $700,000. You know there's room for appreciation. See if you can take advantage of it. And that's how you literally jump the wealth ladder. So if you're a first timer, an investor, a move up buyer, or somebody who's even looking to sell this year, hopefully these market predictions have been helpful. And if you like these videos, make sure you like, comment, and subscribe, and hopefully we'll see you on the next one.